As the broker owner of Velocity Realty in Toronto, I'm frequently interviewed to discuss the latest trends in Toronto's housing market. But today, I have the pleasure of sitting on the other side of the interview table. Today, I'm going to be interviewing Randall Bartlett, who's the Senior Director of Canadian Economics with Desjardins Group. He's based in Toronto and is a regular commentator in the media discussing the latest economic trends in Canada. Now, the conditions we're seeing in Canada's economy today, from high levels of inflation and rapidly rising interest rates, are conditions we haven't seen in decades. Over the past 25 years, Canada has had a relatively stable economy and a housing market where home prices, for the most part, have been trending up. And all of a sudden, we have these big economic shocks that are putting a lot of pressure on households and our economy more generally. And today, I'm going to have Randall walk us through how we got here, why most economists missed or underestimated the high level of inflation we're seeing today, what are the big economic risks that he worries about, and what this all means for Canada's and Toronto's housing markets in the future. As always, if you have any specific questions, please feel free to email me directly at askjohn@movesmartly.com. And now, on to our interview. All right. Randall, thanks so much for joining us today for today's podcast and video on our YouTube Move Smartly channel.
Well, thanks so much for having me, John. It's a real pleasure to be here.
Absolutely. Thank you. So I wanted to just kick off and just start our conversation today about, the one big economic variable and factor that we hear about all the time, and that is, of course, today's high inflation rate, which I think just came out as just under 7%. And to get your thoughts on how we got here, the Bank of Canada's mandate, of course, is to keep inflation in the 1% to 3% range. And for the start of COVID, we're actually below that. And then, beginning in sort of April or so of 2021, it seems like things started to accelerate above 3%. And by June of this year, we had 8.1. So, I'm curious to get your thought on two things. The first, of course, is why do you think most experts, most economists, including, Nobel Prize winning economists, didn't anticipate this? Why did they think, inflation would be transitory, as they say? And then, the second question is, why do you think, the Bank of Canada waited so long? I mean, and why they didn't, at least start tapping the brakes a little earlier? By the time their first rate hike in March, inflation was 6.7%. So do you think they should have been kind of hitting the brakes a little bit earlier?
Well, I mean, I think it's Yogi Berra who said that making predictions is hard, especially about the future. And forecasting has never been a harder business to be in than during the pandemic. And there are a few reasons for that. In particular, just that we've lived through an unprecedented economic and obviously social political shock in the last few years. And so economists base our forecasts and central banks base their policy decision making on what they expect to happen going forward and the impacts of the policies that they introduce. But in an environment where you have a public health shock to the point that you are shutting down your economies to prevent the transmission of a virus, we don't have a precedent for that. There are no benchmarks for that. And so, we can comb data from a century ago, but it's pretty challenging to do in a modern economy, in a modern financial market. So as a result, the expectation was, everybody turned on the taps during the pandemic. Governments did, central banks introduced new monetary policy tools and cut interest rates as low as they possibly could in order to stimulate their economies and prevent us from going into some sort of depression, not knowing necessarily what the consequences would be on the other side, but assuming that the important part was to get past at least the depths of the pandemic and the economic shock. And so what we ended up having, though, throughout that whole period was essentially a classic mismatch of supply and demand, where we had all of these income transfers, borrowing costs were low, that sort of thing. So households were actually made relatively whole compared to what would happen in a typical recession. Their balance sheets were much healthier than they would be coming through a recession. But they couldn't spend the money on services, which we normally do. That's about 2/3 of our consumption basket. So instead, a lot of those resources either went into savings, went into buying assets, financial assets or homes, or buying goods. And so ultimately that led to significant goods inflation to start off with, as we had more dollars chasing fewer goods, and also in the dramatic increases in home prices, as well as in financial assets. And so the central bank assumed that once the economy got back to normal, we'd see production levels, shipments, that sort of thing start to get back to normal. And so we would meet a lot of that goods demand. And we'd also have a movement towards services in terms of spending once things reopen. But it turned out to be less transitory than anyone had expected because of the fact that we just haven't been able to meet that demand. And so as a result, central banks found themselves behind the inflation curve, not just in Canada, but in the U.S., UK, Europe, other developed economies, and so we're all kind of in the same boat right now. So a big part of this is not just sort of the Bank of Canada getting it wrong, but everybody getting behind the curve, and now everyone playing catch up to get out in front of it. Now, to your second question, absolutely. I think every central bank now recognizes that they're behind the curve, and they're all playing catch up to raise rates quickly enough in order to tamp down inflation, drive down inflation expectations, and get wage growth under control too, as all of them are at decades high levels of gains right now.
That's interesting. So from what you're saying, then it sounds like, during the pandemic, a lot of people were just saving and kind of building up their accounts and had tons of cash. And then almost like at some point, things opened up and people started spending, maybe spending more than central banks kind of thought they would. And that's kind of one of the factors that may have kind of brought us to this point in this rapid acceleration.
Yeah, that's certainly part of it. But it was sort of both and in those two things, that there were so few goods available relative to what we normally have in terms of opportunities to spend, and we had more pent up savings than Canadians had historically, as well as, again, it's a global phenomenon that these excess savings started chasing fewer goods, but also chasing financial assets and investing in financial assets, taking on larger mortgages, that sort of thing. So we had a fervent amount of activity in all of these, particularly interest rate sensitive assets. So that would be things like tech and growth and financial market side of things, as well as in terms of housing, while still building up large deposits in bank accounts and chasing these goods and pushing up inflation on that side too. So there was just a wash with liquidity in a way that we've never seen in a recessionary period, in an environment that's totally uncharacteristic of a typical recession.
Yeah, that's helpful. Now, I want to chat a little bit about the future path of interest rates in Canada, but I wanted to first talk about the path of interest rates potentially in the United States through their Federal Reserve. And the U.S. has a very aggressive tone, talking about how they're going to raise rates as high as they have to basically kill inflation. And I often hear, and many people here might hear, analysts in Canada talking about what the Bank of Canada's policy rate kind of doesn't matter. What really matters is the Fed's rate, and their argument is that the Bank of Canada has to follow what the US Federal Reserve is doing. So I'm wondering if you can unpack for listeners why people make that argument. Under what circumstances does the Canadian Bank of Canada need to follow the Federal Reserve? And what happens if we don't in the future?
So I think there is some truth to that the Bank of Canada doesn't need to follow the Fed per se, but it can't be all that far away from where the Fed is at any given time. And there are a couple of reasons for that. And the first one being the Canadian dollar, that if we keep rates, low while the Fed is hiking aggressively, that will lead to a situation where you end up getting a depreciation in the Canadian dollar as the U.S. Attracts more capital flows. And as a result, as the dollar goes down, inflation rises here because of the goods that we import are now more expensive to import. So it's a bit of a double-edged sword. By not following the Fed, sure, we're more stimulative economically, but at the same time, we're actually exacerbating inflation as well by increasing the price of imported goods. And so the Bank of Canada has to be very conscious of that as it's trying to target inflation. The other thing that the Bank of Canada needs to be conscious of is that it really only has a lot of control over the very short end of the curve as well. And so, the overnight rate is the rate at which, the Bank of Canada and banks will lend to each other on an overnight basis. And so the further you get away from that very short-term interest rate, the Bank of Canada doesn't have nearly as much control over where interest rates go. So thinking, 2-year borrowing rate, Government of Canada bond yields, 5 years. And that's really where it matters for a lot of borrowers who are borrowing for a mortgage, is that those longer duration interest rates. And so as a consequence, the Bank of Canada, when it wants to have influence on those, it can't really move all that far away from the Fed either, and really just and really can't get too out of line with the Fed, because it needs to have some influence on those, and it gets pretty minimal the further it goes out.
So do you think that the Bank of Canada will be following the Fed pretty closely? And if we don't, why do you think we won't?
Yeah, I think the Bank of Canada will be following the Fed pretty closely. I mean, it's, again, in this environment, our forecast changes on a pretty regular basis, as does every other forecaster right now. And certainly, we think the Bank of Canada is going to follow the Fed pretty closely in the next meeting as they raise rates, probably both by 75 basis points. We'll see what happens in December. The Fed has put out a path by which it expects to raise rates, but that was before we had a bit of an inflationary surprise recently in the U.S. We've had one in Canada recently too, and so that's been a bit of a game changer. So we'll see, but even if Canada doesn't exactly follow what the Fed is doing, the Bank of Canada will be relatively close to where the Fed is. It's not going to get too far behind the curve. And so I think that's really what people can expect, is not to open up a wide gap between the hiking paths of the two central banks.
Awesome. And does Desjardins have an estimate or a forecast on what you think sort of the top might be for the Bank of Canada's rate in Canada?
Yeah, so we're currently just north of 4% for the terminal rate for the Bank of Canada, so 4.25, and we recently revised up to that rate. We didn't think it'd get nearly this high, as a function of the fact that the Canadian economy is just so interest rate sensitive, and we see it across economic indicators. So we've continuously been revising up, as has pretty much every other forecasting shop, given how hawkish the rhetoric has become at the Bank of Canada, and how clear its stance is on the fact that it plans to get inflation back to 2% in a hurry.
I mean, I still can't, it still blows my mind that we've gone from virtually 0 to 4% in 1 year, but that's the world we live in.
That's the world we live in. Yep.
So earlier this month, Bank of Canada Governor Tiff Macklem came out and said, some of the inflation that we're seeing today reflects global developments that we don't control, but inflation in Canada increasingly reflects what's happening in Canada. The demand for goods and services here at home is running ahead of the economy's ability to supply them, which kind of touches on something we talked about earlier. But when I read that, I thought, well, why is this surprising? I mean, this was really why they pushed rates to 0% 2 years ago, and they've told us it takes 18 to 24 months for their policy rate changes to kind of flow through and transmit through the economy. And it sounds to me, at least, almost like a bit of a mea culpa, that like they feel like, at least in part, today's high inflation is partly due to sort of a little bit of overstimulus. And I mean, you can tell me if you disagree with that, but what I'm really kind of wondering is, if in an effort to cool inflation, is the Bank of Canada making the opposite mistake today? Are we raising rates too high, too fast? Are we getting to the point, in this monetary tightening cycle, where the risk that things break with one more hike is greater than the risk of not raising one more time?
Well, I think what captures the view of the Bank of Canada at the beginning of the pandemic quite well is a quote by then Bank of Canada Governor Stephen Poloz, when he said that no one blames the firefighter for using too much water when they saved the house, right? And so that was the mentality at the time, is that there was so much uncertainty. All we knew at the time was that global markets were freezing up, and that they opened the floodgates and tried to ensure that there was sustained liquidity in financial markets and that sort of thing, and that we didn't end up in a situation of a deep depression. And so that was sort of the attitude going into it. Now, of course, you're right. That is the intention, both of increasing fiscal policy and monetary policy stimulus, is to support domestic demand. That's the whole point of it. And what that does is prevents the economy from having a deeper recession, which is the goal ultimately, but ultimately prevents deflation as well, or severe disinflation. So that was very much the goal. You're exactly right. Now, did they keep their foot on the gas for a little bit too too long. I mean, I think that's pretty evident at this point, both in terms of the fiscal authorities and monetary policy authorities. But they didn't know what the ultimate outcome was going to be of their measures. And it's the same for all major economies around the world. So we're all going through this right now, and a bit of soul searching. And so that has forced them to raise much more aggressively than they had anticipated, to rein in inflation and bring inflation expectations down. Because the only thing that the Bank of Canada really has any control over is raising interest rates to reduce demand in the most interest rate sensitive parts of the economy. So then that's where it starts. So that's housing, that's consumer durables, that's financial markets, and then ultimately it spills over into more broadly into other areas of the economy. And so that is the intent of what they're doing right now, which is exactly the opposite of the intent when they were pushing stimulus out the door. Now, does that mean there's a risk of over tightening? Absolutely. Monetary policy acts with long and variable legs, as economists often say, and so we haven't felt the full impact of the hike we saw in March of this year, let alone the jumbo hikes that we've seen since then of 175 basis points. And so it's certainly we're going to feel the lasting effects of the hikes that we're seeing right now, and are probably going to see through to the end of the year. That's going to keep affecting the Canadian economy and weighing on the Canadian economy into late 2023 and into 2024. And so there's certainly going to be long knock-on effects. And I would say the risks are tilted to the downside for a deeper economic downturn than economists are expecting right now.
Interesting. So they are okay. I mean, that it is important. I mean, when we think about kind of the economic downturn, I think it's a good point, because for the past, I don't know, 4 or 5 months, I mean, we've been hearing both the bank and the federal government being very hopeful that we're going to hit this soft landing, or maybe this very mild recession. But our finance minister Freeland's kind of came out, I think, earlier this week, kind of just talking about how she wasn't very optimistic. And I'm going to quote her because I thought it was very interesting. She said, our economy will slow. There will be people whose mortgage rates will rise. Businesses will no longer be booming. Our unemployment rate will no longer be at its record low. That's going to be the same in Canada. That will be the case in the US, and that will be the case in economies big and small around the world. And then she said there are still some difficult days ahead for Canada's economy. To say otherwise would be misleading. So, it's interesting. I mean, that we've gone from this idea that we might hit this mild recession to something deeper. So, I mean, I guess from your perspective, what do you think the most likely path is, I mean, in terms of a forecast for a recession? And on top of that, what do you think are the key factors that might tip us into a deeper recession, the opposite of this rapid inflationary we have environment today, but something deeper than just this mild recession?
Well, I think I'm glad to see that the finance minister is being honest with Canadians in terms of what they can expect going forward. And we're expecting to see that the Bank of Canada, as it revises its economic forecast when it publishes its next rate announcement next week, we're expecting to see that there's a significant downward revision in the Bank of Canada's outlook, and the bank is clear as well on the likelihood of an impending recession in Canada. And so we're expecting to see, like, Desjardins was one of the first financial institutions to come out with a recession call in Canada, and our view is that we're going to see a relatively mild recession in the first half of next year compared to something we've seen in the past, like the global financial crisis or something like that. We're not expecting to see that level of economic shock in Canada or globally, for that matter. And there are a few reasons for that. We think there's some cushions in the labor market, which is extremely tight. That's why we're seeing such strong wage growth right now. But even if you look at job vacancies in Canada, I mean, there's 3 times what they were still before the pandemic started. So we're still seeing that the labor market is extremely tight in Canada, which is very, very supportive, we think, of a more mild downturn than we've seen in the past. If you look at household deposits, household savings, they still remain elevated compared to where we were the pre-pandemic trend. And so certainly that, I think, bodes well, even though inflation's eaten away at some of that. That'll help support a more mild recession than we might see otherwise. And then the other one is being that we're expecting to see that the automatic stabilizers that governments have, those measures that kick in when the economy weakens, such as employment insurance, that sort of thing, that's all still there, and that's going to again support put a bit of a base around the economic outlook for next year. So while we do think we are going to see a recession, we think that there are reasons to think it's not going to be it's going to be shorter and shallower than we might have seen in the past in a similar sort of environment. But we do think the risks are tilted to the downside in the sense that there is a risk of over tightening, and there is a risk that there are asymmetries within the Canadian housing market in particular. And you would know at least as much, probably much, much more than I do about this, John. But when it comes to things like variable rate mortgages, trigger rates, the ability of households to actually be able to service the mortgages on the homes that they purchased during the pandemic. I think those are really where those asymmetric risks lie around higher interest rates. And so as we do risk scenarios around our baseline forecast, we're certainly of the view that the risks right now are tilted toward an over tightening and ultimately sort of non-linear knock-on effects to the Canadian economy to the downside. So that's our view at this point. We think that the Bank of Canada has been very clear that it will keep tightening and it will keep interest rates elevated until it sees short-term inflation expectations come down to 2%. They're now around 7%. So that's got to be a big change. And so we'll see what happens in January when we get the next survey from the Bank of Canada on consumer expectations. They need to see actual inflation coming down in a meaningful and sustained way, and they need to see wage growth coming down in a meaningful and sustained way. And until those three necessary and sufficient conditions are met, then we don't think the Bank of Canada is going to take its foot off the brake. But once it does start seeing those, we're expecting to see the bank take a prolonged pause, then start to pivot, and then start to actually pull its foot off the brake, probably by the end of next year.
So one thing you said that stands out, and I'm kind of curious about, you mentioned sort of one of the positives is the tight labor market. And I wonder how that helps when, the bank's been pretty clear that they want to drive up the unemployment rate effectively. I mean, they don't want a tight labor market. So, how do we have a mild outcome or mild recession when policymakers are effectively trying to kill jobs? I mean, that's what it sounds like, that they want to, take the pressure off of the wage growth by effectively driving up the unemployment rate.
Yeah, I mean, it's an interesting situation to be forecasting. And so we're about to publish our latest economic forecast on Monday. And we're of the view that we're actually not going to see a deep contraction in employment. So we're not going to see quarters of material declines in employment, but we're seeing that the labor force is growing so quickly that it's really going to be a story of more normalization of the labor market as opposed to one which is sort of some deep contraction in the Canadian labor market. And so we're expecting the unemployment rate to average around 6.5% next year in this environment, which is where we were in 2019, essentially. And so really we're getting back to what is a more typical rate of the unemployment rate in Canada, as opposed to the lowest unemployment rates on record, which is really what we've been working with through the bulk of this year. So it's really more of a rebalancing and renormalization of the Canadian labor market, as opposed to one which is just running as hot as anyone could possibly engineer if they intended to.
That's actually a good point, and I think I think it's helpful to understand that, because I think when a lot of people think about the unemployment rate going up, I mean, obviously most people are thinking or worrying about the worst, but what you're talking about is kind of even just getting ourselves back to 2019, which would help, which is great. Now, I spent a lot of time. My next question I wanted to ask you is about expectations on the rate environment, and I spent a lot of time speaking with consumers and clients and buyers, and I think what's interesting about Canadians right now is that especially with housing, there's just still optimism, I feel like, and especially with homeowners who are looking to sell, like many people are optimistic that rates are going to go down in the near term. And I guess I'm kind of curious to hear from you, like what you think the most likely timeline, like how long are 5.5% mortgage rates staying with us? Like how long, like realistically, and I do worry that a lot of households aren't prepared. Anyone who's renewing a mortgage in the next 12 months, I think the vast majority have no idea what's going to hit them when they get the renewal. So, what do you think the realistic timeline is for high rates? I mean, obviously, we don't know. It's just a rough guess. But and how do you think this is going to impact households and consumption when people's mortgage payments are going to go up, 50% at renewal?
Yeah, so I mean, to answer the first question, we think that mortgage rates are going to remain elevated throughout much of next year, and a big part of that is that we're expecting policy rates to, even though we're expecting them to stop raising by the end of this year, we're not expecting them to cut until the very end of next year and start that cutting process. And so ultimately, that's going to mean that variable rates remain elevated for that prolonged period of time. But we do expect to see that as the Bank of Canada sort of starts to change its language, that you start to see the longer term bond yields do start to come down. So, your 10-year bond yield, 5-year bond yield. And so ultimately, that's going to be something that then starts to feed into more fixed rate mortgages before variable rate, and those start to come down potentially a little bit earlier. And so that's currently what we're forecasting. And so, our expectation is that we're going to start to see a shift in like a downshift in longer term yields, probably in the early part of next year, as the Bank of Canada takes that pause and then starts pointing to the fact of what it might be looking at in order to actually change direction. And so, so that's obviously going to have implications for the Canadian housing market and the type of mortgages that Canadians take on. And you can already see it in the monthly data from the Bank of Canada that while we're seeing that the share of variable rate mortgages that are being issued is falling, not just in absolute terms, but also as a share of the total. We're actually seeing that it's a shorter term fixed rate mortgages that people seem to be moving more towards. So not locking in the 5-year, not going the variable, but something sort of in between to handle the uncertainty over the next couple of years. And so it seems that people's behavior is really sort of fitting with the narrative that you're hearing, is that there is that uncertainty, but they think ultimately those rates are going to start to come back down again. So people don't want to lock in for the longer term if they don't necessarily have to. And you're seeing it hitting Canadian households. Like a big part of what's driving up shelter inflation is mortgage interest cost. And we saw that again move up even higher again in the September data that we got yesterday. And so it is driving a lot of the increase in costs for Canadians right now, even as other shelter costs are starting to fall, like homeowners replacement costs, that kind of thing, which are more linked to say like new home prices.
Yeah.
And so so as a result, that is weighing on Canadians and forcing them to adjust their behavior to accommodate the higher costs that they're facing elsewhere. So that's certainly a struggle for a lot of Canadians. We're seeing that real income growth has been negative as a result. So even though wages are moving higher, we're still seeing that inflation is higher than wage growth, and so still we're seeing negative real wage growth, and that's something that the Canadians are obviously struggling with, particularly those households that are lower income than others.
That's helpful. And do you think over the next, 12 to 24, I mean, it seems like we're going to have high-ish rates for at least the next couple of years. To what extent is this going to weigh on the economy? I mean, I don't know, 20% of households renew their mortgages every year. So they're going to feel some sort of interest rate or payment shock. And do you see that kind of flowing through into making things worse? I mean, if people are already feeling high inflation and they haven't renewed their mortgage and they have this big rate shock or payment shock, how is this going to flow through, I guess, to the economy? And do you see some potential distress even in the future?
Yeah, I mean, we're seeing it already now in terms of, obviously what we're seeing in the housing sector in terms of that affecting people's decision making, that affecting sale prices of existing homes. And ultimately, it's feeding into consumption as well. You see it in the durables consumption. So that's not just an inflation story, that's also an interest rate story. And so we're expecting you're going to start to see it broaden out in terms of consumption into other, and other categories in terms of non-durables, which makes up, food and energy makes up a big part of that, but also, semi-durables consumption, services consumption. So this year has been a story of, this started off the year, we've had great growth to start the year. And a big part of that was services consumption in Canada. There's a lot of pent up demand for services. But when you look at the data now, that's waning quite considerably. And that's driven in part by inflation, in part by the additional costs that households are facing because of higher interest rates as well. So they're having to, forego some of that discretionary services consumption that they've been looking forward to for the last 2 years. And so ultimately, I mean, this is starting to broaden out, and we're seeing it. We think also we're starting to get some signs of it in the in business investment as well, whether it's investment in machinery and equipment, whether it's investment in non-residential structures like commercial buildings, industrial buildings, that kind of thing. So you're starting to see it broaden out into other categories of GDP and throughout the economy. And so ultimately, that is just going to get deeper as interest rates move that much higher and sentiment on the economic outlook sours.
That's helpful. So we're gonna wrap up slowly by turning to the housing market, and maybe you can kind of give me yours and Desjardins kind of broader. Maybe we'll start with a high level view, like Canadian housing market, what you're seeing and what you're forecasting over the next little while.
So what we're seeing in terms of the existing home market is that we're going to see a continued decline in housing market activity and prices through to the end of next year, where we think it'll broadly stabilize and find its footing again. We've seen that the data has been a little bit lumpy. I mean, it depends on from month to month it can change, but we've seen generally on the sales side just a continued downtrend, and we think that the pace of decline will start to decelerate going forward. And I think we're seeing that in the data. On the price side, that we think that's going to continue to be the case, that we'll see this decline, but the nature of it, we think, is going to change, where we've seen a lot of it at first was concentrated in some of the big CMAs in terms of big cities, in terms of Toronto, Vancouver, Montreal. We think that that's going to change and start to move more toward those communities outside of those big centers that saw the biggest run up in transaction activities and in prices during the pandemic. Part of that is that people are returning to work. Part of it is that obviously interest rates are going up, and that's changing the dynamics in those communities as well. So there are a lot of forces that supported growth in those communities during the pandemic that we think are going to be significant headwinds going forward. So we'll start to see that activity in those communities and prices will start to converge more toward the historical relationship with the GTA over time, GTA, GVA, Montreal over time. Now, part of this is a regional story too. So that's not just within the big provinces. The Maritimes were significant beneficiaries of population outflows from the big provinces during the pandemic, given the lower cost of living, lower cost of housing, great lifestyle more broadly. And so as people were working remotely, they moved to those areas. And we think that some of that's going to start to reverse as well. And they're going to be disproportionately impacted by that reversal in activity and flows. So that's sort of our broad take on the Canadian economy and a little bit on the GTA as well. If you look at where we saw the price gains, or Ontario, look at where we saw the price gains during the pandemic, it was really within sort of a 200 to 300 kilometer radius of the GTA. It was sort of this donut around Toronto, and so we have seen a lot of that reversing already, and we're expecting to see that continue going forward in terms of average sale price of homes and transactions activity. The one thing that's kind of surprised us about the Canadian housing market and continues to are on the housing start side of things. Typically, there's sort of after home sales start to turn over, then you start to see that housing starts do as well, and we haven't seen that yet. In fact, they're moving in very different directions at a rate of divergence like we've never seen. And so this is something that's very, very new, and again makes a forecaster's job a little more difficult when you see this new relationship taking place. But ultimately, historically, they have always converged again, and so our expectation is this may continue into the new year, but ultimately that we're going to see housing starts and new home building activity start to follow sales as well.
Okay, so when do you think we'll start to see a decline in starts? Because at least on the ground in the real estate industry, we're seeing, of course, a decline in pre-construction sales, but that has not, it sounds like, come through in the starts data. Like the starts that are launching today probably were sold a year ago. So when do you think we're going to actually see, because that's obviously going to impact potentially the construction industry. So when do you think we'll start to see a decline in new starts?
Well, we don't have a lot of great data
Okay.
on pre-sale data and pre-sales in Canada, unfortunately. And so that's something that certainly we're continuing to explore and trying to get more data on all the time. And broadly speaking, at this point, like largely it's anecdotal from speaking to real estate investors, from speaking to developers, and getting a sense of what they're seeing on the ground. And it sounds like sort of mid-year next year is sort of the time when that construction is going to be tapering significantly. So whether that's going to be the start of it, or whether that's going to be, we'll have seen some of it start off already in, later in the first half of next year. That's sort of what I'm hearing anecdotally, but whether or not, and that's something that's going to be, diverge significantly on a regional basis, and by type of home construction as well.
Mhm.
But broadly speaking, it sounds like that sort of, potentially around the time that we're thinking we could start to see, meaning we may start to see a decline before that, but a steeper decline, sort of, around mid-year next year is the information we're getting.
That's helpful. Going back to the GTA's housing market, I mean, the GTA is, median prices are down something like 23% around that from the peak at least, and have, interestingly, at least to me, have stabilized the past few months. Now, I mean, do you think it's, and we get this question a lot, like, what are the odds that we see further downward pressure next year on prices? And do you think that's likely and possible just given the path of interest rates?
I do think we are likely to see continued downward pressure on prices into next year, given the higher interest rates.
Mhm.
But we think that most of the weakness is behind us now. That the market is going to be still soft, but
Yeah.
broadly a lot flatter than what we've seen since the peak in February. And there are a few really good reasons for that. I think. I mean, part of that is that return to work, and that people are moving back into the city again, and it's becoming more attractive to be in the city, particularly given the price correction that we've seen so far, and ultimately what we expect to see is an improvement in affordability going into the end of 2024. And so that's certainly, I think, going to be a tailwind for the Toronto market. We're bringing in over 1.3, or plan to bring in over 1.3 million new Canadians over the next 3 years. Historically, about a third of those have gone to the GTA, not just Ontario, but the GTA specifically. And so ultimately, I mean, those are we think are going to be tailwinds to the Toronto market. In addition to the fact that, again, we're seeing that income growth, while below inflation right now, continues to remain elevated and strong, and we expect to see some real wage gains going forward in the second half of next year as inflation comes down. So real wage growth, immigration, and return to work are going to be, we think, key fundamental drivers to the Toronto market.
That's helpful. So one question I've had gotten quite a bit lately is, people are worried about, I mean, people look to the past, obviously, to try to understand the current dynamics. And I've had some people worried that, what we're seeing today might be a repeat of what happened in the late 80s and 90s, where we had this rapid boom in prices. Prices crashed, and it took, 10 to 15 years for prices to recover. It doesn't sound like you think we're on that path, but maybe you can kind of let me know, or what your thoughts are on what the differences are today from from that past period.
Yeah, we're certainly not on that path. Our view is that you do have these fundamental drivers that are going to be supportive to the Toronto market, and more broadly in Ontario. So that's certainly, we think, going to be a positive. If you look at sort of the fundamentals models based on that the Bank of Canada uses, and others, it certainly bodes well, we think, for the long-term prospects of the housing market in the GTA. Another big part of what we're seeing is just this unprecedented level of immigration, as I mentioned, which is something that we weren't seeing at that same time in the 1990s. So you're
Mhm.
bringing in, you're inducing a lot of demand through higher immigration. The other
Mhm.
thing that we have is a dearth of supply in certain housing segments that are desirable to home buyers. And so
Mhm.
that's something that while we're still seeing a lot of supply coming in the market, particularly in multifamily, that's where we're seeing a lot of the starts. There's still going to be demand for detached homes, semi-detached homes, townhouses, that sort of thing. And so that demand is still going to be there among millennials and younger Canadians who are looking to buy their first home as they start families and move on to the next stage of life. And so all of those things, we think, are going to be supportive of a housing market recovery that's not going to look like what we saw in the 1990s.
That's helpful. We're going to wrap up. I'm going to have one last question for you. It's one that I've been getting quite a bit. I haven't had time to answer for people. I have my thoughts, but I want to hear yours. And the question I get a lot is, why are home prices so unbelievably expensive in Canada? I saw on Twitter today, a chart of it was like an OECD chart of the G7 countries, and it basically showed, a chart of home prices and then another chart of price to income ratio and price to rent ratio, which are these traditional metrics we use to measure how affordable a market is. And Canada, of course, was like way ahead of every other country. So maybe like for the average household who's trying to get into the market, what do you think are some of the reasons why homes are so much more expensive here compared to even in the US?
Well, I think I'll talk about Canada generally, but I think even within Canada, there are big differences in different housing markets in Canada. So when you look at like a Calgary, Edmonton, Saskatoon, Winnipeg, that's a very different story. Housing is still quite affordable there. So it's really we're thinking about like a BC, Ontario, and to some extent Quebec, but even Quebec has much better affordability than BC and Ontario do. And so really the issue with affordability in Canada is fundamentally the problem of a couple of big provinces in Canada. That's where it's largely concentrated. That doesn't mask the, I don't want to make lesser of the pain that others are feeling in other parts of the country because of higher rates, but let's face it, that's generally where the issue is concentrated. And a big part of what's driving those is that we have, very high population growth in Canada, and we didn't have housing supply come on at sufficient pace in order to keep up with that. We didn't see what they had in the US, which was during the financial crisis, we saw a huge balance sheet correction in the US where home values plummeted and people were losing their homes. We didn't see that in Canada. The housing market downturn here was just a few quarters, and then it all rebounded and went sailing off again. And so in Canada, we didn't get a big housing market correction. We have very high population growth most of which are coming to those two provinces of BC and Ontario. That's more than half of immigrants come to those two provinces. And so it's one of those things where it's a bit of a perfect storm where we had low rates, lack of supply, high population growth, all of these different factors that sort of spurred housing market activity or home prices within those two provinces. But I think the interesting thing too is that we have a I think a sentiment here in Canada, and maybe it's this idea of we're a country built by immigrants, is just that everybody wants to own a home and everybody wants a backyard, and it's a sentiment you don't find in other parts of the world to the same extent. And so part of I think what pushes up prices and makes people willing to maybe become a little more leveraged than they would otherwise is this desire to own a home in a way that you just don't find culturally in other parts of the world. And so it's important to Canadians. It goes beyond just investment and consumption, but it also relates to I think part of our cultural identity as well.
Awesome. That's a great answer. And thanks so much. And thank you so much for taking the time today to chat about everything that's going on in our economy and helping myself and all of our listeners and viewers make sense of it. So thanks so much, Randall.
My pleasure. Thanks so much for having me, John.